But look at the 10-year dividend CAGR. It's sitting at 17.35%. So that means the company is rapidly increasing the amount they pay out in dividends. Look at this. They've gone from 2013 paying out 35 cents per share to in 2023 $1.87. That is growing dividends at a very fast rate. So we have to understand it's a little give and take when it comes to dividend yield and dividend CAGR. If a company has a lower starting dividend yield, you want to make sure they have a very high dividend growth rate. And the unfortunate news is a lot of the times if a company has a high starting dividend yield, the dividend growth rate is going to be a little bit lower. So you want to kind of find the sweet spot, and it's going to really depend on your goals, which we're going to talk about a little bit later in the video. So now we've talked about dividend yield, we've talked about dividend history, and we've talked about dividend growth. Now we need to make sure we talk about dividend safety and free cash flow. Again, all these dividend metrics are extremely important, and you can't really have one without understanding the other. So the next thing we need to look at is what's known as the payout ratio. You can see we have two listed here. Payout ratio TTM, which stands for trailing 12 months, and we have FCF payout ratio. Now FCF stands for free cash flow, and again, we're going to touch on that here in just a moment. Let's talk about payout ratio. What does this mean? We see the payout ratio isn't in dollar amount, it's a percentage. It's saying 21.72%. So what exactly does that mean? Well, the payout ratio is telling us how much of the company's earnings are having to be used to pay out dividends. So for example, if a company has a payout ratio of 21.72%, and the company has earnings of $100. That means 21.72% of that $100 is going to be used to pay out dividends. Now, why is that important? Well, if a company is using 100% of their earnings to pay out dividends, that means the company can't reinvest back into the business to grow, it means they can't buy back shares, it means they can't pay down debt, and it means they can't attempt to do mergers and acquisitions. So it really limits what a company is able to do. And in a worst case scenario, sometimes that payout ratio will even go above 100%, meaning that that company can likely no longer pay out dividends. So maybe you buy stock with a high starting dividend yield. For example, let's go back and look at AT&T again. We can see this is a company with a high starting dividend yield, sitting at about 6.3%. But just a few years ago, the payout ratio got to around 100% and even above 100%. So what was the result of this? Well, if we look at the yearly dividend payouts, we can see in 2021 it was around $2.08. 2022 it jumped all the way down to $1.35, and in 2023, $1.11. So those dividend payments have actually been decreasing. So if you look at the dividend growth rates, they're in the negative, meaning the company is paying less in dividends over the last few years. This is a disaster for dividend investors. This is the absolute worst thing that we hate to see. So you really have to keep in mind what those payout ratios look like. So let's go ahead and go back to Coca-Cola for another example. We can see Coca-Cola is a company with a 74.22% payout ratio, meaning 74% of their earnings are being used to pay out dividends. Now, this is somewhat like companies. So now we have a general understanding of payout ratio. I actually want to talk about a payout ratio that one of the things we have to understand about payout is so yes, the payout ratio is still at 74.22%, but what if the company kind of messed with the numbers with the way that they do their accounting? They could easily manipulate the payout ratio, which could potentially deceive investors, making them think they're buying stock that has a safe dividend when that might not actually be the case. So what do we do in that case? How do we know if a payout is safe? Well, this is why I personally like to look at the free cash flow payout ratio. Earnings can be easily manipulated, but that's not really the case with free cash flow. Free cash flow is not going to lie to us. And the free cash flow payout ratio is very similar. It's just using free cash flow instead of earnings. It's telling us how much of a company's free cash flow is being used to pay out dividends. So in the case of Coca-Cola, around 81.58% of the company's free cash flow is being used to pay out dividends. So now we've touched on dividend yield, dividend history, dividend safety, and dividend growth. The last thing we need to talk about is free cash flow. This kind of goes along with the free cash flow payout ratio. We need to understand, dividends don't just come from nowhere. So where exactly do dividends come from? Understand, dividends come from one of the most popular ways they can use free cash flow is to reinvest it back into the business. This is a big one. Number 2, they can buy back shares. Number 3, they can pay down debt. 4, they can attempt mergers and acquisitions. But number 5, they can elect to pay out dividends. So you have to keep in mind, anytime they choose to pay out dividends means they have less capital to do those 4 other things. And the vice versa is true. If a company uses all their capital to reinvest back into the business, they don't have any capital left case of Coca-Cola, 5% of their free cash flow to pay out dividends means around 19% of their free cash flow is left over to either reinvest back into the business, buy back shares, pay down debt, or attempt mergers and acquisitions. Now, why is this important to understand? Well, if we understand that dividends are paid out of free cash flow, we can better assess what a company how we plan on rewarding us as a shareholders, and we can also better understand how safe those dividend payments are and potentially how fast they can grow. Well, how can we even know all those things? Well, let's look at an example. If we come over here at Coca-Cola, we can see the 10-year free cash flow CAGR. This is how fast that free cash flow has been growing. It's sitting at about 2.01%. So with a somewhat slow free cash flow growth rate, that means the company probably can't increase the amount they pay out in dividends at a fast rate. And that's the case. We can see Coca-Cola's 10-year dividend CAGR sitting at about 4.75%, which isn't bad, but it's definitely not a high dividend growth rate. But they can't increase their dividends at a high growth rate because the 10-year free cash flow CAGR isn't high. So if we come down here, we can see free cash flow versus dividends paid out. These blue bar charts are going to be free cash flow, and the red bars are going to be dividends paid out. So really what we need to see is we need to see a company generating enough free cash flow to pay out growing dividends every single year. And for example, in 2013, Coca-Cola paid out about $4.9 billion in dividends, but if we look at the blue bar chart, it looks like they generated about $7.9 billion in free cash flow. So they were able to cover all their dividend payments with their free cash flow and had plenty of capital left over to do those 4 other things that I just mentioned. But here's the problem. If we look in 2023, yes, their free cash flow has been growing during this time, but the dividend payments take up a much larger portion of that free cash flow, meaning the company has less capital left over to reinvest back into the business, pay down debt, or attempt mergers and acquisitions, or even buy back shares. So that's definitely something to keep an eye on. So let's go back and look at our other example, Visa again. Like I mentioned earlier, Visa has been growing their dividend payments at a rapid rate. Now, how have they been able to do this? Well, look at the free cash flow growth of the company. The 10-year free cash flow CAGR is sitting at 22.6. You can see this charted out here. The free cash flow in 2013 was sitting at $2.5 billion.
After last month's massive solar flare added a 25th hour to the day, businesses are wondering, what should we do?
I'm thinking company-wide power now.
Anything can change the world of work. From HR to payroll, ADP designs for the next anything.
What is power? Maybe the better question is, how much of it can you...
But if we look at 2023, it's sitting at about $19.7 billion. So if they're growing free cash flow at that high of a rate, it becomes pretty easy to grow their dividend payments at a high rate. So when you're looking at dividend stocks and you're wondering, will this company be able to grow their dividend payments at a high rate in the future? Few things we need to look at. Look at the free cash flow CAGR. Are they growing free cash flow at a high rate? Look at the payout ratio. How much of their free cash flow are they having to use to pay out dividends? Because if it's a lot, it means the company doesn't have a lot of capital left over to reinvest back into the business, which will grow the dividend over time as well. So when I first started dividend investing, buying a stock like Visa would have been something I would have never done. I would have looked at the dividend yield and immediately thought, no way am I buying this stock. When you look at it in the context of all these other metrics, you start to realize this company actually looks like a pretty good dividend investment opportunity if you're a long-term investor. Which this actually brings me to my second point. Yes, for me, Visa does look like a pretty good dividend stock opportunity, but depending on your goals, it either could or could not be a good opportunity. And here's what I mean by this. The end goal for my personal dividend portfolio is to one day be able to live off the dividend payments. That means I have all my expenses covered by the dividend income payments that are coming straight into my bank account. And so because of that, I do have a somewhat long-term time horizon. But that's not necessarily the case for everyone. Typically, people who are interested in dividend investing fall into 2 categories. Number 1, they may be like me. They might have a long time horizon, someone who's looking to live off dividends far into the future. But then number 2, we have people who might be closer to retirement age and people who might want to start using dividend payments to immediately start covering some of their bills, even if it's not all. These are people looking for large dividend payments immediately. And it's really important you understand which of these groups you fall into.
Sí,
Because
sí,
like we
sí.
just saw, I
Envíalo a
personally
mi
think Visa is a
secretario
good
e mándelo
opportunity
con
for
mi
my
sello.
personal goals and my
Agora
personal
vos mando
portfolio.
despedir.
It has high levels of dividend growth, has very safe dividend payments, and is growing free cash flow at a
Those
high
who
rate.
teach
So
this
even though
ocean of
dividend yield
wisdom
isn't large right now,
realize
I'm
the
not really worried
momentary
about that
nature
because
of
dividend
things.
payments are going to keep growing over time. But if I was someone looking for immediate dividend payments to help cover some of my bills, Visa probably wouldn't be the right opportunity for me. Again, this is why you have to understand your goals when you're looking at these dividend stocks. If I'm looking for big dividend payments, maybe I look at something else. Maybe we plug in stock ticker MO, Altria Group. We can see for Altria Group, the starting dividend yield is much higher, sitting at 8.63%. This is a company that makes big dividend payments, but one of the things we'll notice is the payout ratios are quite a bit higher for this company. This company is having to use most of its free cash flow to pay out dividends. We can also see the 5-year dividend CAGR sitting at about 3.63%. So the dividend payments aren't necessarily growing at a very fast rate, and we can see the 5-year free cash flow CAGR is pretty low, sitting at about 2.2%. So the company's not growing at a very high rate. They're using most of the capital to pay out dividends. But if you're someone looking for immediate dividend income, maybe this is something you want to consider. Now, something else we have to understand when talking about our personal goals as dividend investors, we have to make sure that the goals we set for ourselves are actually live off dividend payments in the next 5 years. Is only around $5,000. That's contributing about $100 every single month. Well, I'm not going to even come close to being able to live off dividends on those types of goals. So we need to put things into perspective. We need to see how far off are we from actually achieving our goals. And that's one of the reasons I built this spreadsheet with my dividend portfolio. It shows me the future based on some assumptions. And again, for example, the long-term goal for my personal dividend portfolio is to one day be able to live off of dividend income. So if we zoom in right here, we can see some of the assumptions I'm making with my personal dividend portfolio. And if we jump to my live off dividends analysis, this is going to break down when I can actually achieve that goal. You can see we have some key metrics here. It's telling me when I can live off dividends, how much I'm making every month in dividends, what my account value is, and what my cost of living will be. So for example, if we start scrolling down, we can see, based off the assumptions I plugged in 10 years, I still can't achieve this goal. If we keep scrolling down, it looks like in about 14, close to 15 years, that's the point at which I would be able to live off of dividend payments with the assumptions that I plugged in. So what I would have to do is jump back over to my portfolio projection tab, look at these assumptions, and make sure this is something that I can actually achieve, something that's actually doable. Because if not, I need to adjust it to something that is achievable and look at how long it will take me. So again, we need to understand what type of investor are we? Are we long-term? Are we someone looking for immediate dividend income? And are our goals realistic? So by now, maybe you're starting to think, okay, I'm starting to get a hang of this thing. I kind of understand what I'm looking at when I'm looking at dividend metrics. I understand what my personal goals are. I'm ready to start building my personal dividend portfolio. And that's great. You are pretty close to being on your way, but there's a couple more things that I need to touch on. And one of the things we have to understand is risk tolerance. Now, this is something that a lot of people may understand, but that's not always the case, especially when we have years like 2022 and 2020. Let me show you what I mean. This is something I was recently talking about in my free newsletter that I sent out.
Wix gives you the freedom to tell your story with a professional website that reflects who you are and what you have to offer. Customize every element of your website to meet your needs and achieve your goals. Create a unique visual experience that
every Friday, link in the description. We can see the S&P 500 annual returns over the past 100 years. Now, at a quick glance, you might not think this looks like anything too crazy. We see a lot more green than we do red, which is obviously a great sign. But we have to understand, how can they handle those red numbers? Look at this. We can see 2022, the market dove down by about 20%. That is a massive decline. We can see there was a relatively large decline in 2018, close to around 7 or 8%. We can see during the financial crisis, there was a decline that was almost 40% in a single year. And we can also see during the early 2000s, the dot-com bubble, we actually had 3 years in a row of negative returns. We saw around negative 10%, around negative 15%, close to negative 25%. That's 3 years in a row of negative returns. Now, what you might be thinking is, yes, that's true, but I also know that the average return of the market is around 7 or 8 or even 9% every single year. That's the average. And yes, you're actually absolutely correct, and that's something we have to keep in mind. But there's something else we have to keep in mind. The average return of the market over the past decade actually is around 7 to 9%, but that's not typically what happens. The chart we're looking at here is the distribution of S&P 500 2023. If we come down here, we can see exactly what years the market returned between negative 20 to negative 10, negative 10 to 0, 0 to 10%, 10% to 20%, 20% to 30%, and so on. And what we'll notice is the most frequent returns for the market is between 10 and 20%. That happened the most times over the past 100 years. And if you look at 0% to 10%, yes, we can see this happen pretty frequently as well, but we also saw returns of negative 10% to 0% just as often as we saw returns of 0% to 10%. That's a little more frightening when you put that into perspective. We've seen around 6 years where the market returned negative 10 to negative 20%, 3 years where it's been negative 20 to negative 30, 2 where it's 30 to 40, and even 1 where it was negative 40%. So when we think about risk tolerance, yes, everybody has in mind that the market on average is going to return 7 to 8 to even 9%. But that's not what's going to typically happen. We're going to see huge market fluctuations, and if you can't handle those investments, you probably don't need to be investing at all. Like I mentioned, in 2022, the market jumped down by around 20%. A lot of people were frightened, and there was a lot of uncertainty in the economy. But because I'm personally a long-term dividend investor, I knew this was actually a good thing for me. This created opportunity, and I bought a lot of stocks that I felt were trading at great values at that time. And in fact, if we even zoom in, we can see I'm still reaping the benefits of some of these purchases I've made. For example, look at this stock here, Broadcom, stock ticker AVGO. I bought this stock when the market was way down, and I'm now up around 169.22% on it. Come over here, we can see Microsoft. This is another stock in the buy. I'm up around 57% on this position. So while market downturns scare a lot of people away from investing into the market, or they might even sell out of some of their positions, if you're a long-term dividend investor, you understand this creates opportunity. But again, one of the things there will be a lot of volatility. Years when the market's up 25%, but also ready for years when the market is down 25%. So now we should have a general understanding of dividend metrics, what our goals are, and better understand risk tolerance, and while the average is 50% for market returns, the volatility of that is quite a bit higher. Now the next thing I want to talk about is high-yielding dividend stocks versus dividend growth stocks, and we've talked about this a little bit. A lot of dividend growth stocks have lower starting yields, but increase their dividend payouts at a high rate, and the opposite is true for high-yielding stocks. A lot of these companies have higher starting dividend yields with low dividend growth rates. And here's what typically happens when we talk about dividend growth stocks versus high-yielding stocks. At first, high-yielding stocks are going to provide more dividend income. That's pretty obvious. They have a higher starting dividend yield. We can see these companies, again, pay out more in dividends to start, while dividend growth companies pay out less in dividends to start. But we have to keep in mind, dividend growth stocks are increasing the amount they pay out in dividends at a much higher rate than high-yielding stocks. So we can see eventually, the amount they pay out in dividends is actually going to pass high-yielding stocks. And since I personally have a long time horizon, this is why I like to buy dividend growth stocks. Again, you can see, dividend growth stocks provide more dividend income long-term, high-yielding dividend stocks provide more dividend income short-term. That's the basic concept you have to understand about these two types of investments. Now, if you're still confused how dividend growth pays more long-term, let's look at a quick example. And again, this is something I talked about in my newsletter just a few months ago. Let's look at the example of Broadcom, stock ticker AVGO. If we look at them in 2013, this was a company trading at $35.64 per share. At the time, they were paying out 19 cents 4 times a year, which means they're paying out 76 cents every single year in dividend income. Now, with a stock price of $35.64 and paying out 76 cents a year in dividend income, they had a starting dividend yield of just 2.13%. That's not a very high starting dividend yield. So that means if we invested $1,000 into this company with a dividend yield of 2.13%, we'd be getting paid around $21.50
We feel free
every single year in dividend
because we
income.
lack the very
What we have to keep
language
in
to
mind is this
articulate
company
our
rapidly
unfreedom.
increased the amount they paid out in dividends over the past decade. So let's look at where they were at the beginning of 2024. If we scroll down a little bit, we can see at the beginning of 2024, they were paying out
Just as
$5.25 in dividend income 4 times a year, meaning they're paying out $21 every single year in dividend income. Now keep in mind, when we originally bought this stock in 2013 in this example, the stock price was $35.64, but now they're paying out $21 every single year in dividend income. That means the dividend yield on cost we would have for this company is sitting at 58.92%. So a one-time purchase at $35.64 would give us $21 in dividend income, giving us a 58.92% yield on cost. So in this example, that original $1,000 investment we made in 2013 would be paying us $589.23. That is absolutely remarkable. Imagine getting paid $589 every single year for a one-time $1,000 investment. That doesn't even include the massive share price appreciation and capital gains you would have seen during that time period. So when it comes to deciding between high-yielding stocks and dividend growth stocks and picking which is best for you, again, it comes down to this statement.
Liberty Mutual is all she talks about since we saved hundreds by bundling our home and auto insurance.
Dividend growth is typically going to provide more share price appreciation and more dividend income long-term, but high-yielding dividend stocks will provide more dividend income immediately. So again, if you're someone closer to retirement age or someone looking to use dividend payments to immediately start helping paying off some bills, then maybe high-yielding stocks are for you in that scenario. So by now, you should start to have a feel for what type of investor you are and what to look for. But one of the things I have to point out, I can't let this video end without discussing it, is diversification. Now, it's probably a word you've heard before, and you think you have a general understanding of it. That's probably true. We know it's pretty risky to invest all of our money into any one stock, because if something happened to that company, something happened to that industry, that could be pretty financial devastating. So to mitigate this risk, a lot of people say maybe you should consider owning around 12 to 25 or even around 30 stocks. I personally currently own around 30, but I'd like to get this a little bit lower to around 25. And the reason behind that is it will help get rid of risk in your portfolio. If something bad happens to one company, you still have plenty of other companies that are performing very well, upholding your portfolio. And that's where a lot of people leave it off. But there's a little bit more to diversification than this. There's two other things we should be keeping in mind. So let's go ahead and zoom in and look at my personal portfolio. Again, yes, you can see it's properly diversified, and this one large position is actually what's known as a dividend ETF, which means it's holding a lot of companies within one single ETF. So this is actually a diversified position as well. But if we scroll down, we'll see something different. We can see stock allocation by industry. So we're not just looking at individual stocks now, we're looking at all the different industries in my personal portfolio. So for example, if I own 20 different companies in my portfolio, but every single one of them was a technology company, I might think at first I'm properly diversified since I own 20 companies, but if they're all in the technology sector, there's still a lot of risk in that portfolio and you're probably not properly diversified. The same could be true with real estate. Maybe I own 20 real estate companies. I might feel diversified, but I'm really not since all of my capital is in real estate. So one of the things you want to make sure is that you are diversified across different industries. Again, very important that you understand that. And then the final point about diversification that I want to point out is one that's really important for dividend investors in particular. And that's looking at your diversification of dividend income. Now, what am I talking about here? This isn't something that's talked about frequently. Well, for example, in my personal portfolio, technology pays me around 6.7% of my total dividend income. Now, that's interesting because if I jump back over to my investment dashboard and blow up my allocation by industry, we can see technology makes up 15.4% of my portfolio. So even though they're 15.4% of my portfolio, we can see they make up around 6.7% of my dividend income. So what does this tell us? Well, we want to make sure not all of our dividend income is coming from any one single place. So even if I held 15 different companies across different industries, if all of my dividend income is still coming from one predominant industry, there's still a lot of risk in that portfolio because, for example, maybe something bad happens to real estate and it makes up most of my dividend income. All of a sudden, my dividend portfolio might not be doing so good if all my dividend income is coming from real estate and real estate is not performing well. So again, we have to diversify across different industries, not only with the companies we hold, but also with where our dividend income is coming from. Now, the last thing that I want to mention when it comes to building your dividend portfolio is the idea of valuation. I'm not going to lie, this one's a little bit more complicated, I have to admit, and it's more of an art than science, but it is worth mentioning. We have to keep in mind, even if we find the best dividend stock ever, the absolute best business, if we pay too much for it, then it's still not a good investment in the end. So on a simple basis, maybe we find the best dividend stock ever, it's trading at $100 a share. If we pay $200 a share for it, then it's not going to be a very good investment for us, is it? So how can we know if a company is trading at a good value? Now again, this is an absolute art in itself, and people have been researching the idea of valuation for hundreds, if not thousands of years, and this is something I'm particularly interested in. But I'm going to break it down as simply as I can for you today. Now, one of the easiest ways to start valuing a company is by using what is known as the dividend discount rate. And this only pertains to dividend stocks, as you could probably guess. But it's valuing a company based off how much they pay out in dividends and how much those dividend payments are increasing over time. Again, there's lots of other valuation methods. Let's just look at this one for example. So the company we're currently looking at is Microsoft. We can see right here, we have years listed off, and then we have their yearly dividend payment over the last few years. And then we have their quarterly dividend payouts over the past few years and the amount they paid out every single year in dividends over the last few years. And then we can see our year-over-year dividend growth rates. It looks like a lot of the times Microsoft is increasing their dividend payments by around 10%. We can see 10.05, 10.43, close to 10% at 9.84, and the most recent dividend increase at about 7.53%. So clearly this company is increasing dividends at a pretty high rate. So what we need for this valuation to work is project a dividend growth rate and a discount rate. Now, discount rate, again, this is an art in itself, but a lot of investors will use a target discount rate of around 7 or 9%. Let's say in the case of Microsoft, we go with a 9% discount rate, and we think they're going to increase their dividend payments at a rate of about 8.25% moving forward. Once I hit enter, we can see, looks like we come to intrinsic value for Microsoft of about $433. This means we think Microsoft is worth about $433. That's how much we're willing to pay. So if the current trading price for them is $414.70, when we look at all the dividend metrics that they have and we decide it aligns with our long-term goals, maybe this could potentially be a good company to consider adding to our portfolio. Now, let me be completely clear. This was a very, very basic and simple way of valuing a company. We didn't even get into the valuations such as the multiples valuation, the discounted cash flow analysis, the grams valuation, or some other valuation models as well. It's more of the idea that I want you to make sure you're looking for companies that you believe are great companies and are trading at a good value. Again, I have plenty of other tutorials on my YouTube channel on how to do all of these different valuation models if you want to check those out. So in this video, we have touched on a lot. We talked about understanding dividend metrics, understanding what our personal goals are, understanding risk tolerance and volatility. You should now know whether you want to focus on high yielding stocks or dividend growth stocks. You should understand diversification and even understand valuation just for a little bit. If you feel comfortable with all those topics, then I think you're ready to start dividend investing. If you do it right, I can guarantee it is not something you'll regret.
Red alert, everybody. Trump is creating mass panic and fear in cryptocurrency, or is this the greatest opportunity and will be the greatest missed opportunity in our living history? Now, what's happening is people are absolutely freaking out. Even people that have been in crypto for a very, very long time are losing their faith. Think about this for just a moment. If you don't know why you're invested in something and you're asking what to invest in, you will get wrecked 100% of the time. But if you have deep conviction and understanding why you're invested, just like I know why I'm invested in XRP, and when they initiated the case, the SEC against Ripple on December 20th, 2020, I said I'm holding on like a tick on a dog. That's why I love the red. This is going to go away. This is max pain right now, and it's the greatest opportunity, the greatest buy-in prices that we will ever experience in our living history. Now, I'm only telling you exactly what I'm doing. I will never share with you something I'm not doing myself. I put my money where my mouth is, but I want you to go back to my channel since 2020 and see if my narrative has changed. I've talked about the same things over and over and over again, repeatedly, and I've stuck with it. Because the key is to understand why you're invested in something. I know why I'm invested. That's why when I see this stuff, I celebrate. Red, I celebrate. Green, I get out. Okay? So I'm going to share with you some news, okay? And then we're going to break down exactly what I'm doing. Huge warning to everybody out there. I'm not DMing you. I don't use WhatsApp. I don't use Telegram. QFS accounts are a scam. I don't care how great the AI technology looks, that is not us reaching out to you. QFS accounts are a scam. Never, ever send your crypto to anybody. Obviously, I'm not in my studio today. I'm not traveling, so we're going to do the best we can. I hope the audio is fine, so let's get after it, okay? So let's check this out, guys. So the first thing I want to show you guys that just in, the Bitcoin Fear and Greed Index is now back at extreme fear. You need to learn to invert everything. Fear is green to me. Green is fear to me. Invert everything. Okay, when they tell you to look this way, there's always another narrative going on this way. Okay, so we know that's what's actually happening right now. There's massive fear. But on the other hand, we have Bitcoin Strategic Reserve. Ripple beat the SEC. Ripple will be one of the most disruptive companies in the financial industry. XRP will be one of the most valuable assets in the world. I put my money where my mouth is on that one. And things like this are happening right now. Remember, BlackRock, I showed you guys, is getting their crypto to be up and running as a asset firm in the UK. BlackRock is the largest asset manager in the world and is number 2 holder in Bitcoin. Okay, so Eleanor Trett put this out. A new delegation from the world's largest asset manager, BlackRock, met with SEC.gov Crypto Task Force. Okay, so stop for just a minute. Okay, the largest asset manager in the world met with the SEC Crypto Task Force this week to discuss the firm's existing crypto ETFs and the potential for allowing a future in-kind redemptions and creations for them. Guys, the largest asset manager in the world, with 11 trillion under management. They're bigger than almost largest countries. Sorry, there's a bunch of people around here. I'm doing the best I can. they're bigger than most countries' GDPs. These people are staring at me like, who is this wacko? I'm in a place where it's really cold. Got a cutoff shirt, got a bun. I look like a hippy dippy, and I'm not in a hippy dippy area. Just put it that way. So, Bitcoin news with this out. And sorry, I also got mouth surgery. Just so you guys know, I like to tell you guys what's going on. So I've been on this big health journey, guys. I went through a parasite. Lost weight, lost 31 pounds, 11% body fat, and then I went into a biological dentistry. I got my root canals taken out. I got all the mercury taken out of my mouth, all the metals, and I got all organic fillings in. And then, yeah, I feel fantastic. So I'm really coming out of it. But I have the surgery was 2 weeks ago, and so don't tell my dentist. Where are we at here? Sorry, it's really hard to concentrate with these people here, but that's okay. This is their spot, not mine. Ripple just fired massive shots in the stablecoin war. RLUSD is now live on Kraken, and it's already repping 10 billion in volume with a booming 250 million market cap. It's just another coin, or is this just another coin? This isn't just another coin. This is Ripple's answer to real-world DeFi and global payments. Okay, I'm gonna speed this up a little bit. People are staring at me. I like it a lot. All right, so Jimmy Valley posted this. This is really cool. This is something that's remember I told you the asset managers, the very asset managers, tax accountants, financial advisors told you to run from crypto are the very feverishly trying to get into crypto. I said in April 2020, I called Fidelity, where I held a substantial retirement funds and asked them to get exposure to their digital asset fund, which they were actively marketing on social. They told me no. 5 years later, just in 6 trillion asset manager Fidelity launches retirement plan allowing direct crypto investments. I'm gonna bring you guys back on my screen. All right, so here we are. This will be a shorter video today. So they're having a management meeting right now. So maybe I should jump in there and teach them efficiency. So here we are. So what am I doing? Okay, I'm celebrating. Our warriors are celebrating. We love this, okay, because we're in it for the long term. If you're in it for the short term, you're gonna get wrecked. Okay? You have to learn how to fish. Warren Buffett says it himself. Buy when there's blood in the streets. When it's red and you know what you hold, you calmly buy on the way down. When it's green going up, if you have a plan, then you pull profits, okay? Now here's exactly what I do. I hold Bitcoin. I'm holding it forever. An example of that is I just took a Bitcoin asset-backed loan to open up my financial services firm. Okay, that's an example of why I didn't sell the Bitcoin. I took the Bitcoin, I leveraged it, I got 70% of the LTV. Okay, then I took that LTV and I got cash immediately. I took the cash, I bought the firm, and our firm will pay back that in the next 12 months. I didn't have to, there's no tax implications of that. I'm paying about 14% interest on that money, but Bitcoin goes up 50% every single year. So think about that. Bitcoin's going up 50%. I'm borrowing at 14%. Okay, the firm, I take the cash from the firm and I put it back in my LTV goes back in. So that's an example, okay, of an asset back. This is one thing. Just be very, very careful around getting liquidated. Okay, now here's the negative side of that, right? I always look at risk. If Bitcoin collapses, sorry, I didn't mean to cuss. Damn it, sorry about that. Because I'm really doing better because I know a lot of family people watch that. Sorry about that. I apologize because I do listen to you guys. If Bitcoin collapses, I get liquidated. So I have to pay attention to it. But we feel, based on our analysis, that Bitcoin's going to continue to go up on the back end of the year. And so we feel very safe with that decision. If not, I obviously have more liquidity that I can pump into it. So we're just keeping an eye on it, right? We're going to pay it off as quick as possible. So just want to be very clear about that. Do not go leverage your crypto unless you have a plan. Like, we can pay that back right now, but we didn't want to use our cash. We'd rather use someone else's cash. Does that make sense? So put that makes sense down below, okay? So if you're in crypto and you don't have the ability to pay that off if something happens very quickly within minutes, then don't do it. Okay, so we looked at the risk versus reward. We'd rather use someone else's money, our own money, OPM, other people's money. We borrowed against it. We opened the firm. We were able to get it up and running. We didn't have to go to the bank and, submit our paperwork, LLCs, our firstborn, all that stuff. Once the KYC was done, it took about 2 weeks to do the KYC. Once the KYC is set up, boom, you can easily do it efficiently. And sorry, I'm totally lost my focus. They're having a management meeting. I feel so bad. And then everything else, so I have all my other cryptocurrencies as it goes up the risk pyramid. So cryptocurrency, high risk, high return. When I return off my altcoins, I'm pulling 50%. I think it's going to blow off top of the back of the year. I think August and beyond. I'm going to pull 50% down the risk pyramid. I use cash value life insurance. I use Index Universal Life to bank on myself. Okay. Once those buckets are full, I'm going to buy a little bit more silver. I'm not as adept in silver now because I was buying more under the last administration. I felt less good about the economy, not as good about the economy. We have multiple businesses like information technology, attention, education, and financial services, cash generating dividend ETF strategies, and we're getting more into real estate, something I got to get into because I need tax liability. So basically what I do is every Wednesday and Friday when I get paid for my companies, I pay myself first. So my money's going every day into crypto, dollar cost averaging. When it dips, I buy. Every month I have money going into my insurance policies, right? Just to protect, compound, and grow, banking on myself. I can borrow against my cash value, my life insurance policies. Every Wednesday and Friday when I got paid, I could put more money into crypto, and I put more money into my dividend ETF strategy. When my dividends pay me monthly income, I transmute that from an inflationary asset, the US dollar, and I transmute it into a deflationary asset, Bitcoin and XRP, okay? So every day I'm buying crypto. When it dips, I buy more. Okay. Every month I have money going into my policies, right? My premiums, and if I can put the excess in there, I will. Then we got the money going in the dividend. I pay myself first, always. In America, what we do is we spend, then we save what's left. I save, and then I can only afford what's left. Does that make sense? So I just did an example on my Instagram story. Take a look. There was a dividend I just got today. It's my smallest dividend, $240, $275. That's a car payment, right? I took my money, transmuted it into a dividend. I'm now getting paid money off of my money, okay? So if I'm to buy a car or an asset or not a liability, I'm going to put it into something that generates cash and let somebody else pay for it, okay? So every time I get paid, I'm always transmuting that money. That's all I got for you guys. Sorry, this isn't my environment. I'm a little off. Big warning out there. I will never proactively DM you. Those are all scammers. I don't use WhatsApp. I don't use Telegram. QFS accounts are a scam. We're not asking you to send us crypto. Just never send your crypto to anybody, okay? I do have resources for you. So in our academy, we've helped 11,000 people. It's going up rapidly. 11,000 people since 2020. We are the calm in the storm. We are the group where you want to stay calm. If shit's hitting the fan, my team is live in there explaining to you exactly what's going on. We give you a fish, okay? We're not saying what, we're showing you example portfolios, an example, so you can learn how to do it yourself. Entry plans, exit plans. How do you enter? How do you exit? What does it look like? What does our diversification plan look like, and why do we do it, right? You have live calls, market calls, community calls, Q&A calls. Again, like I said, when shit's hitting the fan, my team is live in there. Say, take a deep breath, right? Take a deep breath. We got this. So that is the 3T Warrior Academy. That's down below in this YouTube video description, or in my bio, you have the Coach JV Academy. We'd love to see you in there as well. And then on the other side, I have my financial services company. So we've helped people all over the United States understand cash flow.
Steve, you always buy books, but I never see you reading.
Paperweights. Hey, do you mind getting this because I only have euros?
My pleasure, because I earn unlimited 2% cash back.
We split that.
No.
Unlimited 2% cash back. The Wells Fargo Active Cash Credit Card.
So it's book your next hotel.
If you don't book, it's a shame.
So it's resort.
Sweet vacation home for your next great stay.
What is going on, everybody? Welcome to the Cosmic Wonder. Today we got a new promo for the Fantastic Four First Steps. This was released by Empire, where they talked with the director Matt Shakman about how they filmed the Fantastic Four, and they also do give us some plot details about the film as well. And they kind of actually give us great details about what I would say would be the beginning of the Fantastic Four movie, talking about who they were before they get their superpowers and what happens immediately after they get their superpowers, plus the process of getting the powers as well. I also think that there could be some intentional misdirection in this new promo, especially when it comes to other superheroes